So with that, on to kind of the meat of stuff here, just our 2024 market outlook. This is the main thing. This is arguably the main takeaway of this session, anyways, of this entire meeting. And I think it's worth just taking a step back. What did we think a year ago? That title's updated, obviously, for today, but the rest of that slide, this is our conclusion slide, shot for shot from a year ago. This is what we wrote a year ago at this meeting. Normal seasonal pattern, limited downside through winter, strong crop insurance prices, early summer highs, major rally unlikely, lower by harvest but not as extreme as 2013. Those were the things we said in January would happen in 2023. If you look at this chart, you could see there higher through March. We had record crop insurance prices. You had an early summer rally. It was barely higher than your winter highs, and you fell into harvest drastically, but you did not fall to as low as you did in 2013, the year we were comparing to. So just making the point, you couldn't hardly write that recap after it happened any better than what we said here January a year ago. So this is important, because the problem we get as farmers and even us at Lighthouse is whatever's happening right in front of us tends to just take precedent in these markets. But you can unpack these broader fundamentals and have a pretty good roadmap for what is likely to happen in the upcoming year. And that's what we're going to do here. Do the same exercise for 24. We're going to make some conclusions about 24, and we're going to gather here in 25 and do this again and see how our conclusions for this year shook out. But I just wanted to, this is also a slide we touch on every year. Forming a long-term opinion on markets, it's not, here's a tweet of a soybean field in Brazil, and that's my long-term opinion on the markets. It's U.S. and world balance sheets are where it starts. Just what is the current state of global grain stocks? Long-term weather outlooks. What is the, where are we at in sea surface temperature? Are we La Nina? Are we El Nino? What is the longer-term predictions? Macro trends. What's inflation doing? What are energies doing? That sort of thing. We are huge at Lighthouse into analog comparisons, looking at this year and comparing it to other years that have very similar, setup to this year. And then the ultimate one, just manage money, looking what the large speculator's position is. What does the large speculator think about all this? So if you look at those 5 things, you can draw some pretty healthy conclusions about what's likely to happen in the upcoming year. That's what we did a year ago, and it served us well through 2023. That's what we're going to do right now, and we'll see how it plays out. I think, too, I want to just set the stage here. I was driving to work a few weeks ago, or it was probably early January or early December, and there was just on a sidewalk alongside 41st, there was a moped just parked there, just like someone just drove it and then just the heck with it. I don't need it anymore. I'm just going to park it and leave it. And I thought that's a really good analogy for how you should think about markets. Like, you guys, a lot of farmers treat their market opinion like a Lamborghini. Like, it is just, I'm bullish on the markets, and this is just central to me, and nothing's going to change it. This is my market opinion is a Lamborghini. I am just driving it no matter what. I'm going to protect it. I'm going to find other farmers that have this same Lamborghini, and we're going to stick to that opinion no matter what. Your opinion on markets should be like a moped. It should be useful for you. Ride it as long as you can, but when something changes, you just leave it on the side of the road and you move on to the next vehicle. And that's how we think about markets. We're never right or wrong about the markets, just conditions change and whatnot. But this is the problem on the farm. Well, don't you, the Ukraine war, this, that, the other, no, you're treating that opinion like a Lamborghini, like it's the most precious thing in your world. Your opinion on the market is a moped. That is something you ride when it's fun, when it's convenient, and you drop it and find another one when circumstances change. So just to think about that in that context here. But as we just kind of start with balance sheets, let's look at this here. We just had the pivotal January WASDE report last Friday. Minor increase to U.S. corn carryout. It takes you to 14.8% stocks to use. That's the highest it's been since, if you look on this chart, if you go back into that 2014 to 2019 stretch, those mediocre years, you had similar type carryout. So you're at a carryout level that is not associated at all with major price rallies on U.S. corn. It's not unbelievably burdensome. It's not crazy, but it's not at levels that typically correspond with big rallies. World corn carryout's a little bit different. Even with the Chinese stocks increases last week, you're still sitting here at 23% stocks to use. That's actually not, that's about in line with where we've been the last 5 years. It's down quite a bit from the levels we peaked out at 16, 17, 18, 19. So you're not, world corn stocks, that was actually where one of our glimmers of hope was. If you take those 10 million metric ton the USDA found in China, if you take them out of this, that number drops, you're actually at a fairly snug world corn carryout. So beans are the exact opposite. Even with the minor carryout increase from Friday, you're still at 6.7% stocks to use. That's very tight. Beans are used to that. You can see that's kind of where we've been the last decade, other than the trade war years, the 17, 18, and then into 18, 19. So you're tight on beans. You're not as tight as you have been, but you're fairly tight on beans. But here's the problem on beans. This is your world balance sheet. You've climbed all the way to 20.7% stocks to use. That is quite burdensome for world beans. That's a modern era high apart from the trade war year. You're at the highest, global bean carryout. So, and where are these beans at? They're not. It's not like wheat where it's spread all over the globe. The world bean carryout is in China, it's in Argentina and Brazil, and it's in the U.S. So you've got plenty of, and that's just those trade flows. So you got plenty of. If you look at how the world balance sheet on beans is and how beans move around the world, this is pretty burdensome. This is a challenge to a sustained bean rally, no matter how bullish the U.S. situation is at any moment in time. Spring wheat, you're actually, so 34.6 for stocks to use on spring wheat. That's not, if you think about the 2017 drought here, your stocks to use are about the same as they were that year. You're only up marginally from the previous 2 years. In those really bearish 2017, 18, 19, 20 years, you had wheat stocks, spring wheat stocks to use that approached 50%. You had nearly half your crop sitting in the bin. So this is not bullish for spring wheat, but it's nowhere near as bad as we've seen. And similar story on world wheat. Your world wheat carry out, and this is inclusive of China. If it looks a little different if you just look at a major exporter carry out, but if you just look at the all world wheat carry out, you were down, to your lowest levels in the last half decade here, and you're at what would be considered historically fairly snug. Not a burden, not running out of wheat, not necessarily bullish, but this is not a framework that's impossible to get a rally from. You would need help, on the fundamental side, but it's at least conceptually there's a framework there to get a rally. So balance sheet wise, U.S. corn is problematic for any kind of rally. World corn, though, is neutral. Soybeans are the opposite. U.S. beans, very bullish, but world bean balance sheet, very bearish. Wheat is kind of neutral on both here. Not tight balance sheets in the U.S. or the world, but not so ugly that it's just impossible to get a rally. So that's where things look balance sheet standpoint. Long-term weather, and this is spurious at best here to make these statements because things change. But one of the things I want to just share here, weather itself is just so misused here. And the farmer driving his Lamborghini market opinion around misuses weather pretty badly too. They look at a picture of this field and this and that. These charts are vegetative index charts. That's satellite imagery. It's free to the world. You could create your own vegetative index charts. It's not subjective. There's no opinions. And this is as far as where conditions are at any point in time. This is as objective and as useful a measure as we've ever found. So if you look at South American weather, they're nearly through the growing season in central northern Brazil, and they're off. They're probably 40% through it in Argentina and southern Brazil. You can see here, Argentina a year ago, that yellow line, that vegetative index was at the bottom of the entire range when they had their huge drought. This year, they're at the top of that range. They're set to have a huge crop. More importantly, though, look at Brazil here on the vegetative index, and we've been hearing about drought and people trying to get bulled up on Brazil. Your vegetative index score is actually higher than a year ago in Brazil, and you're in the very top end of your range here. So at least from a vegetative index standpoint, there's not much support here right now on these South American beans that you've got a weather story here today, and that you ever did, really. Maybe briefly in early December, late November, that sort of time frame. So U.S. weather, it's the middle of winter here. There's not a lot constructive to say. I think it's worth noting, somewhere between mild and strong El Nino is kind of the prevailing thought into summer. Those are not typically associated with major crop problems in the U.S. Those are highly correlated with trend to above trend yields. So if you just look at the sea surface temps, there's nothing today that would tell us there's a higher than normal probability of a major crop problem. I think this is the latest drought map. These winter drought maps they don't correlate at all. They're zero, like literally zero correlation. There's almost no correlation between winter drought and summer drought, but you do have the whole state of Iowa in a severe drought, most of it in a level 4 drought. So if that persists into the spring, it could provide some support to this market. If you have the whole state of Iowa planting into a drought, again, that's not likely to be that's not a Lamborghini. Don't ride that all the way to harvest, but that'll be a moped for a while that you can ride. We don't personally think there's anything in here that we should be suggesting anything other than trend yield. This drought story this may be worth a little bit of a rally here, though, in the early part of the growing season. So outside markets, and you may have picked up on a theme in this presentation. There's not a ton of good news, and it's the same on outside markets. So just to tie this all together, this inflation story is actually easy. This top chart is consumer price index. You can see how inflation is coming down, and that's just month over month inflation. So we're still seeing inflation. Prices are still going up, but they're going up at a slower rate. And a lot of the Fed's recent comments over the last few months have been pretty dovish. They've been pretty consistent about we've got a handle on this. We're going to start, taking steps to ease back on inflation, cutting interest rates, and so forth. And so this, if you were to overlay this consumer price index chart with like a aggregate commodity chart, they would track incredibly well. Managed money, the large speculator, they wanted to own commodities through this entire inflation period. It also helped that you had some major crop issues in grains. It was perfect for them. They wanted to be long this thing. They don't want to own commodities anymore. They want to be short them. They look at this inflation story easing, that's bearish for commodities. And then they look at those balance sheet charts that we just looked at, and then they look at grains, especially corn and wheat, and these huge carries. Carries are free money to be short, selling short into a market that's in a carry is free money. That market's got to rally up to the level you're sold at as time goes by, just to even start. So the managed money has a really strong pull to be short. It's going to be tough to flush them out of that position. It's going to take more than just a brief weather scare or things like that. The other bearish change that had some headline risk right away, but it'll be a bigger just structural thing as we go forward here, the Argentine election. So Argentina's dealt with years and years of runaway inflation in their markets, and they finally just enough, and they elected just a far right-wing libertarian candidate that came in and said there's a whole host of just sweeping economic changes, but two of the most pressing, the immediate changes they enacted. So what happens in Argentina now is their currency is devaluing so rapidly that farmer just hangs on to grain. They would rather have the grain than the stinking Argentine pesos, because those, no matter what prices do, they'll get more pesos tomorrow if they wait from today. So that actually affected trade flows. Like Argentina did not want to, farmers sell into that. As you stop this inflation and do the opposite, that Argentine farmer is going to stop hoarding. And at the same time, at least this year, they've got a huge crop coming down there. The other big change is that new administration's embracing, there's a lot of like GMO prohibitions in Argentina and so forth, and that's all going away now. So you're going to see their production increase even more as they embrace all the best technology there. So this Argentine situation is not supportive. The other thing that's changed here, so a year ago, the main reason we liked grains to not fall as much as they did in 2013 during 2023 was you had this soybean oil for renewable diesel expansion story. You had all these new crush plants being built, all this demand to go into the renewable diesel market. Some of it's happening here in North Dakota. You have a plant built in the eastern part of the state to supply soybean oil to an oil plant in the western part of the state. Well, what happened during the year here, this bottom chart shows veg oil and animal fat recycled oil imports into the U.S. You've just, and as markets tend to do, they find their own solutions. You've had just a slug of alternative oil imports into the U.S. You've had more in 2023 than the entire rest of the data set combined as far back as these records go. You've just had this recycled oil coming from every direction, and it's totally undercut the soybean oil story, and with it this so the crush plants are still being built. There's still that side of the demand story, but crush margins are coming down. The demand for soybean oil is not what we thought. You've kind of lost a lot of the shine off this renewable biodiesel story as it relates to just being super bullish for soybeans. So really took it on the chin in the outside markets in the last few months here. Little bit of good news, or just life preserver type news here on the managed money position. So you think about managed money, the large speculator. The government gives us data every week that shows the aggregate of all their positions, how much long or short, how much they bought or sold. And what you can see is very clearly on a chart like this, that iceberg is the managed money net position. As it dips down, and the lower it gets, it's very much correlated with markets stopping their descent. And that makes some sense, right? Like once everyone's sold, there's no one left to sell, the markets stop falling. And we're getting close to that point on corn right now. We're record net short for the time of year. Funds have never sold as much corn in January as they are right now. So we're record short for the time of year. We're starting to close in on record net short for any time of year. All the previous records, if you look back at those bottom valleys and so forth, it's all Q4, or the lead up to harvest and stuff like that. So this is actually the sort of position that is highly correlated with some degree of market bounce. Just managed money is all in. They're sold. There's nobody left to sell it. If you piggyback on that, canola and spring wheat are also at record all-time net shorts, and managed. And on soybeans, it's not record net short, but they're the shortest they've been since early 2020 when the rally started, and they're also net short. They're below zero for the first time since 2020. So if we look at managed money, the large speculator, their behaviors massively influence grain price, and they've seen all our slides before. They're already thinking all this. A lot of this is already priced into the market. They are loaded up really short already. They like this story. The inflation coming down, the carries in the market, they want to stay short, but you'll be able to spook them out of a position this short with some. It won't take a huge, you don't have to have an earth-shattering rally, case. It won't take much to start spooking at least some short covering out of this. So seasonal here. We're huge at Lighthouse into seasonals in our weekly commentary. Almost every week we reference seasonals. We talk about, and they're extremely reliable on grains. They're not foolproof. If only it was literally the exact same, but you can look at a year like this year, and you can look at other years that you had a similar fundamental construct. So all those things we just talked about, what were some years that we had similar? We've been talking 2014, which is the red line. So these lines are 2024 on top, and then 14, 15, 16. 2014 is the most obvious, and it's an extension of 2013. You had a nearly identical set of fundamentals going into it. 15 and 16 were also very similar. And you could see a couple of things here that stand out. In 2015, we had a bearish WASDE report in January like we did this year. Grains continued to trade lower all winter into early summer. In 2014, bullish WASDE rally started now. That this is more likely to follow this 2015 pattern just based on what we had last Friday. But in all 3 years, and actually in every year this century except for one, you still made that major seasonal rally that you saw in the summer. And in every one of these years, you rallied back to at least 105% of the price you were at on new crop corn the prior December. So this year that would put you somewhere in the 520 to 550 range. And keep in mind, it was April in 14, it was June in 16, and it was July in 15. So it's down the road a ways yet. We won't know the exact construct. It's always some degree of U.S. growing weather, but if you were to, I could have thrown 20 more lines on this chart and we would see the same phenomenon every year. There's a strong seasonal tendency to rally. There's very little seasonal chance of a major rally. When we're talking about a rally, when we're talking about getting back to these levels that we could have sold for new crop in September, October of last year, that sort of thing. Soybeans, same phenomenon. Soybeans, if you look at the green line in the middle, 2015, it's now more similar to this year because, again, bearish WASDE report. In 2015, you just barely, in your rally in late June, early July, you just barely got to your Q4 highs from the year prior, but you did make that rally. And prior to that, you just traded lower all through the winter. Spring wheat, similar story. Spring wheat does have a pretty well-defined April-May seasonal. A lot of your seasonal is typically earlier in spring wheat. It's tied to the timing of winter wheat and when that crop's most stressed most years and so forth. But you can see the same thing if we use 2015 as the most likely in all three of these seasonal comparisons. Wheat kept falling through the winter. You had a modest early spring summer rally. Same thing though, even getting back to 100% of your Q4 price looks like about the most you would expect. So, right now that means somewhere around $7.90 to $8 September wheat is what we would expect in a seasonal rally, is just kind of the upper limit of that. So conclusion, and this, again, this is not the most exciting stuff to hear. It is what we think is reality, and that's one of the reasons we started with the recap from a year ago. That I think it's better to have a reasonably well-informed reality than a completely enjoyable fantasy here. So the biggest thing in all this, your bullish 20 to 23 stories are essentially gone now. Like that entire case for that 3-year rally, that's all faded. The outside markets, the internal grain balance sheets, all of those things are gone. But we do think this bearish news is mostly priced in. We alluded to that. Large spec has, the speculators loaded up net short. The stupid Jan WASDE report with its bearish, corn number especially, it's going to make it tough to make a case to rally here over the next 3-4 months. So we're probably going to keep drifting lower. We're certainly not going to have record crop insurance prices in February. We're probably going to keep drifting lower through the winter. But again, there is a strong probability of a seasonal rally sometime between April and July, maybe early August at the latest, that gets you back to 100 to 105% of your Q4 highs. That is, we don't know the exact catalyst, what it is today. We don't know what's that moped that we're hopping on. Then we just know that seasonally it tells us when we get there'll be a moped waiting for us to hop on that. So that's still very likely. Coming out the back side of that, significant further downside risk into harvest. And every one of these years, once you made your spring, summer, seasonal rally, it's straight down into harvest based on what we know today. And also just our longer term bearish view remains on these markets. We've been showing this chart a few times here in our weekly commentary, but this 2010 to 2013, now 2014 cycle, it mirrors almost identically what's happened in 2020 to 2024. That's continuous weekly chart. Those spikes from 2010 to 2013, those are also from 2020 to 2023. The two arrows, it shows where you're at in 2014, and then you are here today. So you can see, if we were having this meeting 10 years ago today, what was in store for us. We did have a big rally that gave us a brief window to sell that summer. And in each of the next subsequent years, we had minor, just fleeting, look at how short those spikes are. They're 1 or 2 weeks in a lot of cases in those summer rallies where you could sell prices similar to today's level. Most of the time you were mired in just pretty mediocre prices through that time frame. Interesting tidbit, and when we had our early spring rally in 2014, that price was the high for 2014, 15, and 16 for corn, beans, and wheat. Like if you would have sold 2016 corn during that April 2014 rally, you would not have been able to sell a higher price than that over the next 2.5 years. Your seasonal still, like your Jan 1 price of that year, you still rallied beyond that, but you never made it back to the level you were at in April of 2014. So we can't ignore the similarities fundamentally between the two stretches, and this seasonal chart speaks for itself here. This is the pattern. This is where we are at right now in these markets. So that's what we think. Still strong probability of seasonal rally. Will give us an opportunity to sell what we need to still on these grains, but beyond that, it looks like the longer term trend, there's still more downside, these grains. So We're going to switch gears and talk about benchmarking, but any questions on the markets? Anything? Half of you guys, every time we talk, you question everything we say on the markets. There's got to be a question. So.